Patrick, you've made $1 million mistake too. You just don't know it yet.
Right.
And so is everybody else. The time value of money is important. And it's something that people don't really think about. No competition. If you do something different, nobody's going to do that stuff. Nobody's going to make an option loan. Nobody's going to call the We Buy Houses guy. Do something different.
Welcome to the Real Estate 101 podcast. I'm your host today, Patrick Donley, and with me today is Casey Mericle. Casey, welcome to the show.
Thanks, Patrick. Appreciate you having me.
Yeah, it's great to have you on. We connected recently on real estate Twitter, which for those of our listeners who aren't real estate Twitter junkies, tell us a little bit about your origin story, your background, what life was like maybe before real estate, and then how you first got the itch to get down, start going down the real estate path.
So I remember being a little kid wanting to house hack, but I'm so old that they didn't call it house hacking back then. My idea as a youngster was, hey, buy a duplex, rent out the other side, see how it goes, right? Unfortunately, I never really got to that goal. So I made a U-turn somewhere. But yeah, from there, I don't know, 07, 08, something like that, I started buying foreclosures on the courthouse steps. Got my teeth sunk into that. That's quite a shark pit if you've never done that. And flipped a couple houses, married my wife, started having a family, said to myself, hey, I've got to do something else other than my job full time in my spare time, flip houses, because I'm not going to have time to raise our son. So kind of went from that to notes, performing and non-performing notes, and then got into creative financing, hard money lending, and then commercial stuff. Yeah.
Cool. A lot of different stuff. As I mentioned, I started following you on Twitter, and what I really liked, one of the questions somebody asked was, what was the most impactful book that that's been on your life? A lot of people kind of gave typical responses like Rich Dad, Poor Dad, Think and Grow Rich, maybe the Bible, maybe Atlas Shrugged. You said the most impactful book for you was a book called Introduction to Real Estate Option Strategies. I'm a huge reader, and that is a completely new one for me. I've never heard of it. Talk to us a little bit about that. Why was that book so impactful for you?
Honestly, it's made me a ton of money. So that you'll probably notice I'm direct. So it's made me a bunch of money, but that's not really everything. So that book is chocked full with hundreds of ideas. It's kind of a course with like a workbook with it and an audio recording. So, and there's two parts to it, but in it, there's hundreds of ideas regarding real estate options, their applications, and how and when to use them. And options are really one of my favorite things to do in real estate. If I've got a deal to put together, I'd like to have an option. That quite frankly, I steal a lot of stuff from Jack Miller and I repurpose it on Twitter. So that's what I'd say.
Yeah, that's cool. I want to kind of do a little deeper dive here into options. I'm familiar with them a little bit with equity markets, like puts and calls, but explain a little bit more in depth, like how do options work in real estate? I know they make you a lot of money, but more of like, why do you like using them so much? And like in a deal, you want to make sure, as you said, you've got an option behind it.
Yeah. Well, so one of the cool things about options, especially in the equity markets, is there's a ton of rules and case laws about options, right? And so that is helpful. A lot of those rules apply to real estate as well. So that's one parallel, if you will. But so options. Let's go down the rabbit hole. So options, what is it, right? It's a unilateral, one-sided contract, right? Where you have the right, but not the obligation to buy. Okay. And if you think about this, it's not unlike an MLS purchase and sale agreement, right? Just for a house, right? or a commercial purchase and sale agreement. Okay. So, in either one of those, you'll find that typically, not always, but typically, you'll find a contingency of some sort. Now, a contingency might be financing. That's a common one, or inspection, right? That's probably even more common. But there's plenty of other contingencies you can have. So, when you think about options and the parallels to a regular purchase and sale agreement, really the difference is unilateral versus bilateral, right? So a purchase and sale agreement has an earnest money deposit, right? So let's say, your earnest money deposit is, I don't know, $20,000, right? That's quite similar to an options consideration. So for the listeners that don't know, options, if they're done right and done well, the buyer will put up something called option consideration. Typically, that's money. It doesn't have to be money, but you can kind of think of it as a non-refundable earnest money deposit, right? So, Patrick, if I'm buying a property from you and I give you $20,000 option consideration and you give me 60 days to close and I don't come back, you keep that money, right? And that is similar to earnest money, right? But in earnest money, you can get the deposit back. In option consideration, you don't. That's it, right? So the dynamics of an option as opposed to your regular PSA is it's unilateral. So only really the buyer has the power, right? So, the buyer might say, hey, this option is contingent upon inspection or whatever.
Can we walk through an example of an option deal that you've done recently and just kind of how you did it, how you structured it? Kind of curious about like objections.
Yeah. So most wholesaler deals are options if they're done correctly, right? So a wholesaler, which is probably the bane of some real estate people's existence, right? But most wholesalers, if they do it right and are smart, will say, hey, seller, I'm going to give you money. And if I don't come back, you keep the money and you sell the house or sell the building again, right? But you keep my money. And then the wholesaler goes and tries to find a buyer at a higher price than he purchased for, right? And makes a spread, right? So that's a really simple option agreement. But the difference really is in between an earnest money deposit, which is refundable, and option consideration, which isn't. I'll give you another example that's longer term that I think you'll like a little more. So I did a couple of years ago, I did something that I like to call an option loan. A free and clear property owner gets a hold of me because they're struggling. Okay. So guy's out of work, kid is needing college money, and said child just wrecked both of his vehicles. He's got a free and clear property. So what I did was I lent him some money, right? I lent him the money he asked for against his property. I lent him far less than his property was worth. The cool thing about this option loan is it didn't have a payment schedule. He's not making me monthly payments. He's out of work. That doesn't solve his problem. So instead, it just compounds. The option just compounds and accrues against basically a strike price or an exercise price, which is something we probably should have talked about in options. But essentially, a strike price or an exercise price is the price that buyer and seller agree to for when an option is exercised in the future that you can purchase for, right? So let's say in this case, it's $500,000, right? And I give him $100,000. That $100,000, instead of him making payments, that $100,000 accrues at $20,000 a year. So the longer it goes, the bigger my equity or yield would be, right? And at some point, I own the property outright. Does that make sense?
Yeah, it does. What are some of the kind of common objections or pushback that you get from sellers when you propose doing an option strategy with them?
Well, hey, hold that thought. This is something that I want to come back to. But what's interesting about that option loan is I like differentiation, right? that property was like a $700,000 property, right? Now, if I go to that guy and try to buy that property for, 20-ish% off, he's going to laugh at me and I'm not going to get the deal done, especially in the last 5 years, right? Like nobody's giving a discount in a hot market. But what's interesting is when you try to do something different, and I just lent him money, right? I got a 20% discount baked in automatically because any bank would get 80% loan to value. And then as the payments compounded and accrued, I'm getting a bigger discount on that property all the time. So it ended up being half off for me if I wanted to exercise. Now that gentleman did cash me out. He refied, but I wasn't unhappy to, take a yield that was a good double-digit yield. That's what I'll say.
A double-digit yield on the loan.
It was, I don't know, it was 20 or 30% yield, probably. I didn't own it, right?
And he's happy. You're happy.
Right. He's happy because no bank would lend him money. I'm happy because I got a great yield on my money. It's super safe because I'm, at the beginning, I'm buying at 80% LTV, but it went down to 50% loan to value. And if I have to own it, I wouldn't be unhappy owning it. The longer it goes, the better it gets. I'm not taxed on it. I don't need a partner to do it.
Are you hoping to own it? I mean, ideally, do you want to own it in the end?
I think it depends on the property. Like, would I be upset with owning that property? No, not at all. I wouldn't be upset. But I don't usually lend. I never lend money unless I'm happy owning the property. That's like a golden rule of mine. So if you're going to put your money into any property, you better make sure you want to own it because one day you might.
So I want to circle back to the objections and the pushback that you get. Is what are some of the objections that, I mean, I would imagine part of your job is you've got to educate people on what you're trying to do. Most real estate investors aren't, sophisticated enough to even know what you're talking about. So is that a big part of it is education initially?
Yeah, well, I mean, it can be. It depends, right? It depends on if you're dealing with somebody sophisticated, if you're dealing with somebody that's not sophisticated. Common objections to an option are, hey, you're going to tie me up, right? I need to sell tomorrow. I don't want to mess with anything other than a sale. Or they're super savvy and they know other ways to make the deal, right? That's it. But education is big. Language is huge. The way you say things is just critically important. Because Patrick, if I come to you and I say, hey, why don't you own or finance, right? You're going to say to yourself, I think, let me get in your head. You're going to say to yourself, oh, well, Casey's asking me for a loan. Casey wants a loan, right? I don't know Casey. So, that's a hard sell, right? It's really difficult to have people get on board with that. Now, if I say to you, Patrick, how would you like to open up a new income stream? That sounds like I'm getting a check in the mail with no work, right? How much do you like paying taxes? Do you like paying taxes or not paying taxes? Because options have a big tax advantage in that you're not taxed until you exercise, right? So if the seller sells, then they aren't taxed until they hit their basis, right? And they might not hit their basis until they exercise. So, it's just it's how you frame things. You've got to educate. You gotta work. You gotta work it. I mean, and it's the thing is, and you'll see this on Twitter. Like I talk about a lot of different things, but this stuff only works part of the time. And people blow me up about it. Like, oh no, I never do that. Well, that's right. But listen, it doesn't have to work a lot for you to do really well, right? It only has to work once or twice. One deal can set your life free. So.
Yeah, interesting. What are the biggest drawbacks or the risks when you enter into an options strategy or an agreement with a seller? What's your downside? Just mainly losing the.
Probably the biggest is understanding or confusing. So if, and I'm guilty as charged of this. So the moment that you confuse another party in a negotiation, the answer is no. It's always no. So you've got to be super careful. And that's where language is helpful, and how you say things is helpful, right? Why I like options so much is because there's very little downside. I don't need partners necessarily, right? And sometimes I want partners, sometimes I don't. There's very little risk. Typically, if you're doing an option deal, your consideration is probably 10% or less of purchase price. I mean, it might bump up to 20% or less. So if you think of doing an option deal as opposed to doing a commercial real estate deal, right? So in a commercial real estate deal, you're typically putting 20% down. You're probably going to a bank or a lender, it might be CMBS, it might be a life co, whatever, right? And they're going to have their lawyers draft up a promissory note that's not so favorable to you, right? And if you don't do what you say you're going to do exactly by those 30 pages of legal lease, you're going to be in big trouble, right? So my preference is to write the option. So I'm writing what the legal lease is. And that's not to say I'm going to try to take advantage of anybody, but there are loan covenants that I've seen that are frankly preposterous, and you would never see those like in an option agreement, right? So having to explain to someone is probably the hardest part, but you're taking less risk. Okay. So like I've gotten option agreements for $1,000, now I've got option agreements for several $100,000, right? So, it's scalable. Usually I'm paying less than 10%, which is better than you can get at a bank, right? So that's important. Okay. I'm taking less risk because if it goes wrong, then I lose that money, right? But it wasn't that much money to begin with. Okay. I typically don't have partners if I'm doing an option agreement. I can if I can't raise the consideration money, right? Or if it's a big, heavy value add rehab kind of project or development project. And it's crazy tax efficient. So, there's nothing that there's hardly anything that I think is a drawback. It solves all kinds of timing issues. It solves seller issues. I mean, there's very little downside. The downside is covered. That's why you should learn more about it. So,
and all that is covered in the options book, the Introduction to Real Estate Strategies that you said was your most impactful book. It's all covered in there.
Yeah, it's in there. So what I would say is that is not a beginner level book. Okay, so if you are not familiar with if you aren't familiar with real estate options, then I wouldn't suggest go get that course right away. That's like step 2 or 3. I've got some other guys that I would give you to kind of start and figure it out.
Yeah, that was my next question is, are there any kind of beginner books that have been impactful on you? Have made a huge difference on your career?
Like if I had to rank some guys that put together some amazing stuff, Jack Miller is my favorite. And these guys all hung out with each other in South Florida, I don't know, in the 70s, 80s, 90s. A few of them are still alive. Jack Shea is a mentor and a friend of mine, and actually has a website you can check out. Let's see, Jack Miller is on a website called Cashflow Depot. John Schaub, if you're going to start anywhere, John Schaub is alive. I think he lives in Sarasota, Florida. He's the introduction guy. So he's got a website. Google him. His stuff is cheap and it's amazing and it's simplified and it's easy. Start with him. Jimmy Napier and Pete Fortunato. Pete Fortunato is still alive, but Pete Fortunato is he's advanced. So, and then Jimmy Napier, maybe one of the best negotiation guys I've ever heard, and he's got a website too.
I've taken one real estate course in my career, and it was the John Schaub. I think I'm pronouncing that. He's the guy that's like how to build wealth one house at a time. Correct?
Yeah, absolutely. Great book.
Yeah,
great.
Yeah, he was there, and Peter Fortunato, and it was a really great course that I took. But that's the only one I've taken, actually. So it sounds like you've spent a fair amount of money and time on going to courses, conventions, things like that. We interviewed Moses Kagan recently, who organized an event called Reconvene, which I think was in LA, and it sounds like you attended it. I'm really curious about that. I've been watching some of the videos and some of the interviews from it, and they, have been great. Want to hear a little bit about your experience there and what some of your biggest lessons were from being there.
Yeah, of course. So what I would say to anyone who is thinking about going, that's a GP and LP, you should go. You should flat go. Best conference I've ever been to, hands down, and it's not close. I am a big Moses Kagan guy, although I would have liked to talk to him more. But hey, maybe some other time. I'll catch him in the DMs maybe if I'm lucky. But the conference is great, and it's not really run like a conference. It's run like a hangout or a get together, right? There is, they've got a keynote speaker, and they've got several sessions where everybody packs into a small venue, and there's, it's kind of like a TED Talk style interview. Well, TED Talk isn't exactly an interview, but like it's a little less formal, but it's really tastefully done, and the whole 3-4 days was tastefully done, and meeting some of the people I met that was just the tremendous part. I mean, there's more real estate brain power per square foot in that room than you probably will find anywhere. And there's people that are great at finding deals, and there's people that have money that want to find those people that are great at finding deals. So, all of that to say, I would highly recommend it if you're a GP or an LP, or if you're just if you're already doing a ton of real estate, it could do nothing but help you. So.
Yeah. Who was your favorite speaker? I'm curious.
I liked them all. They were amazing. I mean, the keynote by Eric Weatherholtz was just chef's kiss good. But my favorite was Shiloh Bear. And you probably haven't seen hers yet. I don't know if it's been released.
No, I haven't.
Yeah. So Shiloh is like a new up and coming GP. She's in the San Francisco area, and she's basically trying to raise money for basically to buy some industrial properties in San Francisco. What I didn't realize as I was walking to the conference, because the hotel is a little ways away from the conference, I don't know, a couple blocks, right? So I'm walking to the conference to, go listen to the speakers, and I'm chatting up Shiloh on the way there, and nobody knows really who the speakers are ahead of time. And I go and sit down, and Shiloh walks up there, and I was like, I don't know that she heard anything I said on the way over here. She's probably got butterflies in her stomach. But the cool thing about what the Kagans do is, they highlighted like up and comers this year, up and coming GPs. And I found, I still feel like I'm an up and coming GP. I'm pretty new to syndication, but that really tugs at my heartstrings, because there's so many people that, are just starting out, right? And, maybe you don't want to give them money, but maybe you can give them advice, or maybe you can point them in the right direction, or maybe you can connect them. And the spark of just one of those things can ignite a career, So I think that's awesome.
Right. Yeah, totally awesome. I would love to go next year to the event. Just, I mean, I've loved watching the videos that they have, introduced or let out on YouTube have been amazing. So I'll put some show links to those videos and make sure that our listeners.
Which one did you like the best so far?
I really liked Nick Huber, the self-storage, the sweaty startup guy. Really, I like that guy. I like whatever, he's kind of controversial a little bit on Twitter. I just kind of like his feistiness a little bit.
Yeah, he's a good dude. But yes, I think he loves to stir it up, which is, I like to stir it up a little bit, but man, he likes to stir it up a lot. So,
he definitely does stir the pot. I wanted to go into some other creative deals that you've done. It sounds like you've done a lot of different asset classes. I think you've been at it almost 20 years, it sounds like.
Yeah.
And so you explained a little how options work, but what are some of the other creative strategies that you really like to use that probably the average investor might not even be aware of?
Yeah, that's a great question. I think I wrote a tweet about this a couple of days ago, right? And we touched on it earlier. Like, I like doing different stuff. Foreclosure investments, right? So the problem with foreclosure investments is that everybody shows up on the courthouse step and they've probably got more money than you, and it's probably cash, right? And they're bidding against each other. And one of my least favorite things in life is buying in an auction, right? I don't like it. I don't like paying more than I have to. I'd much rather be one-on-one, and I'd much rather not have to compete with anyone, right? So what should foreclosure people do that's different, right? Buy the note from the lender ahead of time, right? If there's an auction, if you can buy the note ahead of time, you probably can make a spread. If it's a good deal and there's equity, you can probably make a nice spread in between what you can buy the note for and what the place sells for, right? And it's a note. You don't own the property, right? I mean, there's no liability, right? And if you do that, you're going to beat all the sharks to the auction. So I think that makes a lot of sense. So there's one that I talked about. Hard money lending, right? So most hard money lenders, they're like, they put up a website and they're like, hey, I'm lending money, come see me, right? Or they might go to, they might sponsor a conference, or they might go to a REIA or whatever, right? Hard money lending. I'm a hard money lender. I used to call "We Buy Houses" signs, right? Like, oh, you want some customers? You want to win some money? Call "We Buy Houses" signs. Those guys need money all the time. They got more deals than they have money. So, flip that on its head. Call them. I've made a ton of hard money loans from calling "We Buy Houses" signs, right? Single family water shutoffs. So most people are sending out letters, spending thousands of dollars and getting a 1% response rate. That kills me. There's probably people better at it than me because I used to do it when I was a kid. But I probably spent $50,000, and I don't know if I got one deal from that. Water shutoffs. Go to your local utility, find out who's got their electricity and water shut off, and go find them and make a deal. They're not using that property, so that's perfect for you, right? And then lastly, creative strategy, multifamily, but it doesn't have to be just multifamily, right? Could be anything with property management. Okay, so let's say, Patrick, that the market has been frothy for the last 5 or 10 years. Okay, and let's say that some GPs made some bad decisions. They bought wrong. They underwrote poorly. They couldn't figure out that their taxes were going up. All of you 3 cappers, you can come give me a hug after this. So what is a person that wants to buy an apartment building do? Or it could be any kind of building, bigger building with property management, right? Well, they're hurting or they're distressed, right? So they're doing what they call those cash in refis, right? So GPs are calling their LPs and saying, give me more money so we don't lose this asset. Okay. But instead of that, a savvy property manager that already had property management in place in that area might say, hey, I'll go manage your properties for no out-of-pocket expense for you, right? So, that might be, I don't know, an 8 to 12% savings for them, right? But I want an option to buy, right? Or I want a mortgage, and maybe you secure the option, buy a mortgage, a second mortgage, right? And you can do the same kind of thing as I did in that option loan, right? Like you might cut yourself in on some equity on the deal. You might cut yourself in on some cash flow, some appreciation. Like you could say, oh, you bought this property for $5 million, but anything over $7 million, I get, right? Or you might even trade them, right? So let's say one of their properties is doing really poorly, right? And you say, hey, we'll just let my 10% property management fee compound and accrue. But instead of compounding and accruing for an option on this property, you've got another apartment building down the street with more equity and no cash flow problems. And, give me an option on that, or give me some equity on that, or give me some appreciation on that, all of those things, right? So having that differentiated lens, it can make you a deal when nobody else can make a deal, right? And so that's one thing that I'm really like gung-ho about right now is, everybody that I see on retweet has interest rate fever, right? And can't make a deal. And I'm crying in my soup about that. But they can't make a deal because they do the same thing everybody else does. They go, they offer, they counteroffer, they offer, they counteroffer, they go get traditional financing, and they don't do anything differently than anybody else, but they expect a different outcome. And that's not how the world works. Like there are outliers, and outliers figure out how to make a deal when nobody else can. So, that's what I try to do. I try to make a deal when nobody else can. So,
yeah, that's really cool. Good to get creative. I kind of want to segue a little bit. One thing that I really notice on Twitter following you is you're really open and honest and transparent. And I appreciate that. And you write openly about your mistakes, kind of in the hopes that other people will learn from them or avoid them altogether. But you wrote recently about a $1 million self-storage mistake that you made. I'm just really curious about that, how it happened, how it unfolded, maybe what you would have done differently. Just kind of talk to us about that.
Well, so here's the thing I would say about that. Patrick, you've made $1 million mistake too. You just don't know it yet. And so is everybody else. So
right.
It's something to think about. Food for thought. So everyone's made $1 million mistake. And what I mean by that is let's say you made a $230 mistake. $230 isn't much, right? You might have made a mistake that big in real estate, right?
Sure.
Yes?
Yes.
Okay. So a $230 mistake, right? Well, that's a loss. Okay. That's a loss of compounding, right? So if you take a $230 mistake at 6% for 10 years, that's $1 million. Okay. So making small mistakes can be huge, right? So the time value of money is important. And it's something that people don't really think about is the time value of money, but small mistakes can have huge consequences. But back to my mistake, and I've made I've made so many mistakes, and I'll probably continue to make mistakes. I don't do them purposely, of course, but I purchased a storage facility, and I did all of the things I normally do to check out said storage facility. But what was different about this was the seller. I got the seller's financials like I normally do, right? I got rent rolls like I normally do. I requested and got bank statements like I normally do. Okay. And all of those things are typically required by a lender anyway, right? So it's not a big ask. But what the issue was is that the seller mixed multiple businesses in the same account. And so, I purchased this property thinking it was full because I was led to believe it was full. But I should have checked harder. So, when you look at different locks on all the units, right? When you're looking at bank statements and tax returns that have big enough numbers in them, but they have mixed businesses in them, you really have no idea what you're buying. And I knew that before we purchased, okay? But I continued and purchased because the deal was good enough, regardless of, like, I've done many storage facility acquisitions over the years. The deal was good enough that I thought, okay, even if he's not telling me the truth, this is still a deal. Okay. But, day one, we open everything up and find that the facility that was allegedly 100% full was 60% full. And as you know, 60% can put quite a damper on things, right? So what I would have done is probably negotiated about $100 or $1 million discount on said property, right? But I didn't. And I didn't want anybody else to have to go through that. So, every time I make a mistake, I say to myself, one, I say, you're an idiot. And then two, I say, okay, how can I set this up to where I never make this mistake again? Right. So, and that's where I talk about later on, I should have done a performance lease with this person, performance lease with an option to buy. I leased the property for, say, 12 to 24 months. We agree on a price, but that price might fluctuate up or down based on the performance of the asset, right? So, and then, after 12 or 24 months, then the option would allow me to purchase at the value that made sense based on the occupancy, right? So I paid $1 million more than I should. Now, I have an LP in that deal. I told him, he knows about it. So the first thing is you got to be honest with your LPs, right? But he's not upset with me. And the reason why is because that property after a year it's not totally full, but it's 80% full. And I don't know. We've the asset is worth 50% more than we paid for it. So even though cap rates are expanding, so if cap rates weren't expanding, it'd probably be double, right? So the other lesson learned is if you buy savagely right and low, it can overcome many of your dumb mistakes. And by your dumb mistakes, I mean my dumb mistakes, right? So, but it's so important that, I feel like the mistakes that you find out in books and on Twitter and through courses are so much more important sometimes than the lessons that they're teaching you, right? That's when I talk to people, I want to know about their mistakes, and I know that's like probably not the first thing I should ask them, but I think that's some of the most valuable content you can get.
Yeah, definitely. I agree. I want to talk a little bit about self-directed IRAs. I know you're a really big fan of them. And we've got examples of like Peter Thiel, Ted Weschler from Berkshire Hathaway, who've turned their Roth IRA into like massive amounts of money. Explain to us a little bit about how a self-directed IRA works and how you've been using them to compound your money.
Yeah. So I am a fan of self-directed IRAs. I've got one. I've got a Solo K as well. I like that a little better. And there's differences. So self-directed IRA, smaller. I think you can only contribute maybe $6,000 a year, something like that. And quite frankly, if you mess up your self-directed IRA, and this is important, you've got to know the rules. So important. They can take the whole thing away from you. Whereas a Solo K, I think the contribution limits are $50,000, $60,000, something like that. I haven't looked in a long time because I haven't contributed. And if you mess up a deal, they penalize you, but they don't take away your whole retirement account, which is good. So I love those accounts. I think they get spat on in real estate Twitter because most people are looking at the opportunity cost, and most people are saying, "Oh, well, real estate is already really tax advantaged. Why would I go do that?" But what I would say to you is, I think my self-directed IRA, I changed jobs. It had like $14,000 in it. I've never contributed to it, and it's much, much larger. I Rothed it. That 14, I had to pay $6,000 out of my pocket. That wasn't to convert it to the Roth, and now it's substantial, right? And it's a snowball rolling down a hill. So, I don't, I'm not advocating to put every deal in a self-directed IRA or, one of these account types, but you can do, if you can put a few juicy deals in them by the time you're 59 and a half and convert it to Roth, please convert it to Roth. Then you'd never have to pay taxes again. If you're good at real estate, you'll probably be able to double your money on some deals, and it's all tax free. And I have, there's enough deals in my life where I make a fine living without doing anything in my IRA. But when I get the opportunity and there's something big, then I like to put it in there. But you got to be careful. I don't really like owning assets. I don't like owning hard real estate in my IRA that much. I much prefer doing, hard money loans. That's usually typically what I do in my retirement accounts is hard money loans. They're safer.
Another thing that I saw you write on Twitter, and we may have touched on this, I just kind of want to confirm, but you wrote, real estate is real easy, capital R, capital E, capital A, capital L, real easy when you don't own it, 2, aren't liable for it, 3, haven't personally guaranteed it, 4, don't manage it, 5, have no expenses, 6, aren't taxed on it, 7, have no debt on it, and 8, still get to control it and get dollars from it. This sounds kind of like, when I read that, I was like, what's he talking about here? And I'm curious, can you go into that? What you meant by that statement that you wrote?
Yeah. So I think there's there's 2 trains of thought for that. Options are exactly that. Okay. Now, some will say options have debt on them. No, options don't have debt on them. Property has debt, but the option does not have debt. Okay, so there's a delineation there, right? So, for instance, I've got an option agreement on a storage facility right now, and it's, I don't know, 200-300 units, something like that, right? And all of those things you listed in that list are true. I don't own it. I I don't do any of that, right? Like it's a piece of paper that's recorded, right? And so, but I get what they call I control it, right? So the proceeds and avails, the rents come to me, right? But if there's a problem, I don't own it. That's the fun of options. If somebody's liable, it's not me. I don't own it, right? I didn't have to personally guarantee a note for it. I just got an option to buy it, right? So that's one, right? So options do that. The other thing to do is anything that's like an encumbrance or a title cloud, right? You can get the same impact or effect, maybe not quite as great. With an option, you might get income monthly, right? But with an encumbrance, and that might be a lien of some sort, a title cloud, an easement, something like that, something that's got to be cleared when a owner sells or refinances. You basically get a one-time payment for release of those kinds of things, right? So, what's funny about real estate is everybody scrambles to like Class A buildings, and they want this big shiny tower or whatever, right? But the people that are really making some money have figured out, hey, if I just have a piece of paper and a recorded piece of paper, I can make just as much money, and then nobody can come after me. Nobody knows who I am. I still get the money, right? It's tax advantaged. I mean, there's just all of those things you listed. So
for somebody like a smart, super driven college student, or just somebody right out of college, what kind of advice would you give to them if they want to get involved in real estate?
I would say don't pay more than $1,000 for a course, because you can learn what you need to learn mostly for free. Twitter's free. BiggerPockets is free. I feel like Twitter's the more advanced version of BiggerPockets as far as real estate goes. But I mean that some of the books we talked about are not, they're maybe a couple $100 at most, right? I mean, Invest in Debt is an amazing book, and you can buy it for like $30, right? And it'll blow your hair back. Well, it might bore you, but it'll make you so much money, it's sick, right? So don't spend a ton of money on your education, because you can learn a lot of that stuff for pretty cheap. And then I would say make little mistakes, don't make big mistakes. I think Grant Cardone is a hack, and I think 10xing is an awful idea for somebody who's new. So start small. If you mess up, it's not the end of the world. You started small. But if you 10x in the beginning, and God forbid you have a wife in 10x, you may never live to hear the end of it, right? So start small. It's okay to start small, because you're going to make mistakes. I made $1 million mistake. We just talked about it, and I'm going to continue to make some mistakes, not on purpose, right? But I mean, Buffett's made mistakes, right? Munger's made mistakes. It's part of life. Learn from it. The good deals will pay for the bad deals, like 2 or 3 times over, and you won't have to worry about it. It's fine. Find a partner that will give you grace.
How about conventional advice that you think, that same driven person should just completely ignore and disregard?
I posted this today, and I don't know how it's gone, but
or that you disagree with.
Yeah. So something I disagree with is basis is forever. In the institutional world, basis probably is forever, right? But in anything sub-institutional, I don't think it's forever. And that's the middle market is where I play, and sub-institutional is where I play. So all of you institutional people, after you watch or listen to this, you can find me on Twitter. But basis isn't forever. Here's why. You can sell, get an option to buy it back whenever you want, right? You can raise or lower your basis at a moment's notice. You just need somebody that will buy and give you an option to buy back, right? So, if we think about this in an example, right? So let's say I bought a property and its basis, I bought it for $2 million and I didn't touch it, right? And I said, Patrick, I want you to come and let's say fair market value was $4 million, right? But I got a smoking deal, right? And you're probably thinking, oh, that never happens. But yeah, actually it does happen for somebody that's really good. So, fair market value is $4 million. I bought it for $2 million. Let's say I found a distressed seller and I want to sell it to you for $3 million. You're not unhappy to buy something at 25% off fair market value that's the cash flows well, right? Okay. And you probably wouldn't be opposed to giving me an option to buy it back for $3 million since I did the solid for you of giving it to you for $3 million, right? So let's play that out. Let's say you buy it from me and I get an option to buy it back from you in 10 years at $3 million, right? So what happens then, right? Well, I get to come back in and buy something that might be worth $7 million for $3 million, right? And my basis isn't forever because my basis was $2 million, but now it's more taxable at $3 million, right? So yeah, I don't think basis is forever, but you'll hear that from everybody else. Now, what happened to you in the meantime for 10 years? Okay, you got to buy something, you got to buy a great deal, right? You got to cash flow amazingly well for 10 years. So you're not necessarily unhappy with the deal. You still made a ton of money. You're just out of the asset after 10 years, right? So you probably, you and me are probably now friends, right? And maybe it happens again, or maybe you do it for somebody else. But basis isn't forever.
Right. Casey, this has been great. I really appreciate your time today, and all these kind of more advanced stuff that are available to real estate investors. If you had to kind of summarize or just list one big takeaway that you'd want our listeners to walk away from, what would that be?
Do something different. Don't do the same thing as everybody else. No competition. If you do something different, nobody's going to do that stuff. Nobody's going to make an option loan. Nobody's going to call the We Buy Houses guy. Right. Do something different.
I love it. So for our listeners that want to learn more about you, maybe get in touch with you, what's the best way for them to do that?
Yeah, Twitter at Casey Mericle. So that's CASEYMERICLE. You want to hit me up, just post something, DM me. We can talk about investment, deal structuring. I'm happy to help you with that. If you've got a distress problem, hit me up there. I might have a strategy that could save you. Might not, but I might. So
awesome. Casey, thank you so much for your time. I really enjoyed this.
Thanks, Patrick. I appreciate talking to you, man.
Nonsense. Friggin' nonsense. I've now lived through 2 of these episodes. So the first one being that building. And then the second one being in 2020 during COVID with a much, much larger portfolio. Just to give your listeners some context, we own $200 million worth of buildings now, 50 something apartment buildings in Los Angeles.